So what comes to mind when you hear the term reverse mortgage? Do you get excited like, wow, that's a really cool product? Or are you like a lot of folks who are like, not so sure about that one? Well, that's what today's question and answers with Sharon Bahoman is going to be about. I have special guest Cheryl McCarthy with Mutual of Omaha here to demystify the reverse mortgage. Join us. All right. Well, hello again. Sharon Bahoman here with eXp Realty. Today, I'm real excited. I have Cheryl McCarthy from Mutual of Omaha joining me, and we're going to be tackling a question that a lot of people have about a special mortgage program that's really helpful specifically for seniors. And there are a couple different names for it. And I'm being a little, kind of mysterious here, but you'll understand why in just a moment. So Cheryl McCarthy is with Mutual of Omaha. She is a special in the home equity conversion mortgage, also often known as a reverse mortgage. But there's so much stigma around that term reverse mortgage, and that's why we're having this conversation today. We're going to be answering several questions about reverse mortgages and how they work, because I think a lot of people have a lot of misunderstanding around it. So Cheryl, thank you so much for joining me today.
Well, Sharon, thank you for having me, and that is a great introduction.
Oh.
There are a lot of misconceptions about the reverse mortgage or the home equity conversion mortgage.
Yeah, well, why don't you take a second to tell everyone a little bit about yourself, and how long you've been working with the home equity conversion mortgages.
Perfect. So I've been in banking and finance for over 30 years. And in 2015, I left a major bank to go work for my now current firm, which is Mutual of Omaha Reverse Mortgage. When I heard about the reverse mortgage program, also known as the home equity conversion mortgage, I love the product. I think it's terrific. It's the best loan ever. It gets to help people age in place or use their equity in their home for what they want to do today.
Yeah, no, and that's why I love it so much too. We've talked many times, and I've always shared with you how a lot of my clients and people I really enjoy working with are retirees or people approaching retirement. And often they're either looking to, actually, I've worked with quite a few retirees that are purchasing their first home. But I've also worked with people who are approaching retirement, who are looking to relocate, downsize, or in one case, most recently, upsize, and take advantage of equity that they've built over years to be able to make that transition. So the first thing I want to just have us open up is, what is a home equity conversion mortgage and how does it benefit someone?
Terrific. So you may have heard of first-time home buyers or veterans home loans. Mm-hmm. Well, they're all federally insured loans, and that is the exact same thing as the home equity conversion mortgage. In the late 80s, it became an FHA insured loan, a federal housing insured loan. And they put a lot of protections in place for people that are over the age of 62. And we use that word seniors, but I'm not using that anymore because that doesn't apply to over 62.
That's true. My husband's 62 and he runs around.
Exactly. I'm like, you're not calling me a senior. So when the government, when it became an FHA insured loan, it put a lot of protections in place for the seniors, and it addressed a lot of issues that were in the previous reverse mortgage world, which is where they got the stigma. Mm-hmm. One of the biggest things that we do is that the homeowner is the only one on title, just like any other loan. Mm-hmm. They can pay it off at any time. There's no prepayment penalty. It's their home and they're just getting a loan against it. It's called a home equity conversion mortgage because it's converting a part of the home's equity, not all the home's equity, so that they can use it today. And to your point, they've built up equity over the years, making payments. And in this crazy California market, their home is appreciating like out of this stratosphere, right? So with the home equity conversion mortgage, it allows them to pay off part of the mortgage today and not have to make a mortgage payment. And that's so crucial. So you mentioned working with seniors. I also work with people that are starting to retire. And in California, typically when you start to retire, you may have a large mortgage still.
Right.
And so what's so great about this product is that it pays off the mortgage and it allows you to retire and not have a mortgage payment.
Right.
The other thing is that the reason why that we call it a reverse mortgage is because on a conventional mortgage, you get the lump sum of money, you buy the house, and 30 years later, you've paid it off to zero. Well, with a reverse mortgage, you get the money or you use the money and you're not making payments. So what happens is the loan grows bigger over time.
Mm-hmm.
Does that make sense?
Yes, it does.
And then in 2018, there were some changes to the HECM. And because of house prices, specifically in California, we've come out with a proprietary product, what's called a jumbo reverse mortgage.
Okay.
And so that makes loans it still has all the same regulations and rules as the FHA insured, but it's self-insured instead of government insured.
Okay.
And it's from loans, you can get loans up to $4 million. So
wow.
it makes sense in California when you have these great big house prices.
Yeah.
And then big mortgages to go with them.
Right. Yeah. Or, you have a lot of equity and you want to move somewhere. I mean, you're right. The house prices are still going to be up there. I mean, they may have purchased their home 30 years ago for like $100,000. Well, they go to take that equity that they've built over all this time, but now they're probably looking at homes that are $800,000. I mean, in our area, I mean, if you can find a decent like 3-bedroom condo in certain cities in this area, you're easily going to be spending, $800,000, especially if it's a new construction. And so that's great to know that they have the jumbo product available for people. And then the other thing too about this program is there are a lot of people who are already in their homes. They've been in their home for a long time. They may be empty nesters. They may want to move closer to family. But and if they're trying to stay within the state of California, for example, we both know about Prop 19 that went into effect in July.
Hey.
Yeah, and with the inventory shortage we're having, if people have been kind of holding on to their property and not making that move because they are concerned about their tax bases going up to the newer home value, because again, they may have all that equity and they can certainly use that to purchase the new home. But now instead of having a tax basis based on $100,000 home, they're going to be assessed at, whatever the new home value is. And so this new proposition allows them to carry that tax basis with them throughout the state of California. And then they can take advantage of a program like this that will enable them to make that transition into another home. And the thing that when I'm trying to explain this to people, I was telling you how I was having a conversation with someone and trying to really help them understand, because again, a lot of people have a stigma around reverse mortgages. The big thing is that folks have earned that equity. They've been paying their mortgage, month after month for all these years. And between they're paying down their principal and the appreciation, they've earned that equity. And so they may as well get the benefit of some of that equity, while they can enjoy it and not be struggling, on a fixed income from paycheck to paycheck. And instead look at how they might be able to take advantage of the equity they now have in their home to free up, their cash flow so that they can take care of those things they need to take care of and not have a stress of a housing payment, looming over them every month.
Yeah, and so you touched on a number of different really great points. So one is the people that have paid down their mortgage and they are on a limited or income, right? That a lot of times that happens after you retire. So if they want to use their equity, if they don't look at a reverse mortgage, their options are they have to sell to get some of that equity, or they go to the bank and apply for a home equity loan. What happened in the beginning of COVID is that banks stopped offering home equity loans.
Yeah.
Just the big banks primarily. Yeah. And in the last crisis we had back in 2008, they would freeze the home equity loans because the house values had changed dramatically. So with the home equity conversion mortgage, or the HECM as we call it, it's guaranteed. Once it's in place, you have guaranteed access to those funds. So even if your house goes down in value and your loan is larger than your house, we call that underwater, it makes no difference to you because you have that FHA insurance that you're able to access the money. Doesn't matter how long you live. And this is only for your primary residence. Both
Right.
loans that we were talking about is only for your primary
Very
residence.
good point. Yes.
Yeah. And so it allows them to free up some of their equity. The other thing that happened as a result of COVID is I had a lot of customers that had just turned 62 or in their early 60s or later that were suddenly being retired or lost their job, right? Or lost a large percentage of their income. Well, for them, it's like, okay, I have this mortgage payment. Yes, that some of them went into forbearance, which is a great program. But if you're not coming out of forbearance with the same income before you had COVID, before COVID hit, you're still in the same boat. And so what I'm able to do is refinance those mortgages, pay them off, give them a HECM or a jumbo, and they don't have a mortgage payment, but they can make a mortgage payment. So I tell them, you know what, I understand that you want to say you want to make a mortgage payment, you want to keep this down, put it in a bank account for 6 months. Try what it's like to not make a mortgage payment. At the end of 6 months, if you have a lump sum of money that you want to take and put into against your mortgage balance, you can.
Yeah.
There's, so you can pay it back. I just recommend you never close it because once you have it, it's like, keep it in place,
That's a great solution though. I mean, I hadn't even really considered that. Because like you were saying, these people may have been working, they may be of a qualifying age for the HECM program and have the equity that would enable them to do a refinance like that if they have either lost their job or, been kind of forced into an early retirement and just no longer have the same income to make that monthly mortgage payment. So yeah, that's a great solution I hadn't thought of. So thank you for sharing that.
Yeah, and I talk to a lot of bankers too. So bankers routinely have customers that got their home equity loan when they were working. And it matures because they're usually good for 10 to 12 years. So when it matures, they come back in and they're retired now. Their income might be half of what it was. And suddenly they're not able to qualify for a home equity loan or line of credit.
Yeah.
And one of the requirements of the bank or a conventional home equity loan or line of credit is you have to make monthly payments.
Right.
And with the HECM, you do not. So it gives you options. You can always make monthly payments. And if you're self-employed, you know how that goes. Sometimes it's great. Sometimes it's not so great. And so it gives you options.
Yeah. Wow. That's really cool. See, that's the reason I called you. I'm like, let me call and let's have this conversation about, the benefits of the home equity conversion mortgage. Now we've talked about, let's see, a few of my questions here. Okay, here, let's talk about this one because this is an important one. And this is, I think, one that some people are concerned about and perhaps their heirs, but what options will heirs have if they inherit a home that has a home equity or a HECM, up on the home. If they want to figure out a way to keep the home, or, I guess if they're selling it, it's not really a big deal. They just sell the home and then the loan gets paid off. But I do want to touch on that because I think that's where one of the big misconceptions is. It used to be way, way, way back in the early days of the reverse mortgage, back in the 80s and everything, where there was, I think, a little bit of equity share. And I had an agent that I worked with a couple of years ago that actually listed a property that had one of those really old reverse mortgages on it. And she had a bit of a time with it, but I was trying to explain to her, I said, yeah, that's because it's one of the older ones, but that's not how they do them anymore. So if you can touch a bit on, kind of giving people an idea of how that works when the home is inherited and it's got one of these mortgages and what their options would be.
So great lead in. And to the equity share of days of old, lenders did that because, well, it didn't matter. It was an insurance product. They would be a owner on the home with you. So they would share in the appreciation of the home. In addition, they would then sell you an annuity because most of them were income stream, sending you monthly payments. We call it lifetime payments. So with the new HECM or the new reverse mortgage, there is no equity share allowed. And so you can get lifetime payments, you can get the line of credit, and you can get a lump sum and we can pay off the other mortgage, or you could go a combination, which is what a lot of my customers do. So they have the line of credit, which grows over time that they're able to access. And then they can get some monthly income on a monthly basis. And then they also pay off their mortgages. So it's a great reference. So what happens when the borrowers die? Well, the loan becomes due when it's no longer your primary residence. And that typically happens when somebody moves into either assisted living or a nursing home.
Hospice or something, right?
Yes, yes. If they move out of the house, if you're in a hospice or you've moved out of the house permanently, it's no longer your primary residence.
Okay.
So if you have surgery and you have to go to skilled nursing, that's not an issue. If you travel the world, that's not an issue. It's where you don't live in the house as your primary residence.
Okay.
The other way that happens is when they sell, like you mentioned, or when they pass away. So if both homeowners die, then their heirs inherit the house just like they do with any other house, except there are some things that have to happen almost immediately. And it's unfortunate, but almost immediately, the lender or the servicer will contact the heirs and say, we need to do an appraisal, to get a fair market value. And the reason why they do that is because on a reverse mortgage, you can never owe more than the house is worth. So I have a customer right now that's 105. He got a reverse mortgage a number of years ago because he wanted to travel the world on cruises and take his grandkids. And so he gets to do that.
Right.
And so if his house was worth less than his loan amount, FHA insurance comes in and pays that difference.
Okay.
And so the heirs can actually buy the house for 95% of the appraised value on date of death.
Okay.
If they want to. But most cases that there is value in the house and that is the heirs. So the heirs must pay off the loan within 6 months.
Okay.
They can get extensions up to 1 year. And when I'm paying off the loan, most times that's accomplished by selling the house. Mom and dad have passed away and typically they're older. And so their heirs are older too, so they've had their own home and this kind of stuff. But I do have families where the heirs want to keep or have the house remain in the family. Sometimes one of the sons or daughters is actually living with the parent when the parent passes away. So in that case, they have basically two options, or three. If there are assets from the estate, they can use it to pay off the reverse mortgage. Otherwise, they can list the property to sell, and then the proceeds would be theirs. And the third way would be to get their own conventional loan, if they're not 62, to pay off the reverse mortgage. And I say that because I've had an example where mom had a reverse mortgage, and mom was older in her 90s. When she passed away, her daughter, who inherited the house, also got a reverse mortgage. And so I was able to take out mom's reverse mortgage with the daughter's reverse mortgage.
Okay. And actually, and that brought up another thought. We know that there are times when you may have married couples who have a large age difference. So perhaps one person in the couple was of the age that meets the qualifications for a reverse mortgage, and then their spouse is probably under that age. So what happens in a case where you have a spouse that isn't age qualified for a reverse mortgage, but the spouse that's passed away had a reverse mortgage on the property? Does that make sense the way I asked it?
Yes, it sure does.
Okay.
And very good question. So the spouse is called a non-borrowing spouse.
Okay.
And so if they were married when husband got, or husband or wife, whoever was the older spouse, got the reverse mortgage, then they are covered under the HECM reverse mortgage. It's protections for a non-borrowing spouse. If this older spouse, the one that passed away, was unmarried and then married later, my recommendation is always to try to do refinance to get the other spouse either as a non-borrowing spouse
Okay.
or if they are of age that they are added to the reverse mortgage. So what happens when the older spouse dies? There's protections.
Okay.
But they don't get to use the remainder of the home equity line of credit, for example.
All right.
They don't have to make a mortgage payment.
Okay.
So if there was monthly income coming, or monthly, proceeds, that stops too.
Okay.
But it doesn't, but it's only for protected, and
Right.
it's
So
a
they're
little
not
more.
suddenly homeless. Right. Yeah.
Yeah, exactly. So, and that's been changed, that was after 2014. So there's been, as years have gone on, there's been more protections put in place and more qualifications, not qualifications, but more protections, more value for everybody.
Yeah. No, I mean, and that's why I'm so glad, again, we're having this conversation, because I think it's a program that people just kind of have this one idea of what the program is, and often they don't really understand how wonderful this product is and how helpful it can be for people. And again, because I love working, with our over 50 crowd, I'll stop because I'm over 50.
Yeah, I'm not calling them either.
Okay, so, but knowing the options, they have available beyond just what we're used to seeing, the conventional versus a jumbo, and, knowing that this could be a potential option, just gives people more, opportunity to determine what's going to be the best fit for whatever their objectives or goals are. A lot of times people don't realize, oh gosh, I'm struggling. I've been in this house for 30 years and I'm getting Social Security and all my money.
And then when your spouse dies, your income typically goes down by almost half.
Right.
Yeah. You lose their Social Security or whatever it is that they're doing. Yeah.
Yeah. And so this gives people an opportunity, if they, again, are within that age qualification range and meet, whatever other qualifications are involved. It gives them an opportunity to not have that monthly obligation. So, yeah. And then, go ahead.
I was going to mention something, and it's a statistic that's really mind blowing, that the over 50 age divorce has quadrupled since 1996. Yeah, excuse me. And so some of this is a great tool for that. Yeah. And typically in divorce over the age of 60, it's very devastating financially because you're no longer in your peak earning years, or you're at the end of your earning years. Right. And you have this house that you're together in. So in the past, it's like divide up the assets, sell the house, everybody on their own way. Mm-hmm. Well, with the HECM for purchase, or even the HECM refi, it gives more options. Okay. So if one spouse wanted to stay in the house and needed money to pay off the other spouse, they could get a refinance on the existing house. Wow. And then use the proceeds to pay off the other spouse. Wow. Or you could sell the house, mm-hmm. and both get dispersed with their money. And then if they're over 62, they can use the HECM for purchase. Right. So now you have two purchases. And the reason why that is so beneficial is because, first of all, your income has gone down significantly. Mm-hmm. Husband, wife, no longer dual income household. Right. And you're supporting one household with less income. You're at the end of your earning years. So by not having to tie up your assets in the house, it's converting some of that equity that you can use it today. Mm-hmm. It allows you to have a more comfortable retirement. Yeah. Where if you had to use your assets in your retirement to pay off the X, and that's devastating financially. Right. And then to have a mortgage payment to boot, or a rent payment. Right. Yeah.
No, actually, that's a great point, which is a perfect segue to the H for P.
Yay!
Yay! Yeah, so there are certain situations where you may be looking to purchase a home, and I've worked with retirees who kind of, some of them have qualified as first-time home buyers because it had been many years since they had, last owned a home. And in the case with a couple that I've worked with, they didn't quite have the amount of money to put, the percentage down that would really qualify them for the H4P. However, if someone does have access to financial resources, why don't we share with them that option? Because they could go out and buy a new home and do it with a reverse mortgage and not have mortgage payments, which is pretty cool.
Yeah, so we talked earlier about Prop 19.
Yeah.
And a lot of customers in the East Bay always wanted to move to Rossmore and couldn't do it because they couldn't transfer their tax bases. Well, guess what? Now they get to sell that 4-story or 3-story home and move to Rossmore, which is a great community.
It's a great community if you can stomach the HOA fees. Yeah,
exactly, which are like a mortgage payment.
You get a lot of value for those HOA fees. So
yeah, you do. So I helped one customer that was in a multiple story house, beautiful house in Oakland, sold it, paid off their existing mortgage, but they had a large chunk of cash. Well, your options are to put that all down on your new place and not have a mortgage, put 20% down and get a conventional mortgage with the mortgage payment and the HOA dues, or use part of that money, put it into the house as a down payment. And it's usually over 50%. So the older you are with a reverse mortgage, the more money I can lend you.
Okay.
Okay. So how much I can lend, I'm going to get off the course for a second, is based on the age of the youngest homeowner, the current interest rate, and the appraised value. So it all goes into a pot and I come up with a number. So in the case of Rossmore, let's say the house is worth $500,000. And Rossmore, they have condos, they have single family dwellings, and they have co-ops. Currently, the FHA reverse mortgage is not available for co-ops because of the ownership type. So it's only for the condos and that kind of thing. So you put a large down payment. Let's say the house is worth $600,000. You put $300,000 down. You put $300,000 in the bank. And so you don't have a mortgage payment. You've got a large down payment on your house. Your equity presumably will grow over time as the mortgage balance grows over time, right? Because the house is appreciating. And you have money in the bank that you can use for whatever you want.
Yeah, and then if you have other income sources, you may not even have to touch that money in the bank because you don't have to use that on your mortgage. You can use that for whatever your other expenses would be. So
exactly.
So and that cruise to wherever you want.
Yeah, and, exactly. And if you want to take 10 cruises a year, you can do that. So the other thing that you mentioned, and it's, so some people use the HECM as a strategic planning tool. They have tons of equity in the house. They also have a large investment portfolio. And why they get a home equity conversion mortgage is because they want to have that access to that line of credit. So when the market takes a dip, they're not having to pull money out of their investments and take a loss on it. They can pull it from their house. And when you have those two assets together, your overall portfolio performs better. So it's a wicked thing. It's called sequence of returns, but you ask the best questions. You're such a good host.
Oh, I just think, I just think this is such a great program. And, the challenge that because you do this all day long, you're much better at being able to kind of address a lot of the questions people may have. And I don't know that I'm always as quick on my feet when those unique questions about the program come up, but I just, when I meet people who can take advantage of it, especially if they express to me that they're really struggling on a limited income, and it's like, but you're sitting on all this equity in this home that you've been paying the mortgage on for the last 25 years, that can help you. But it's a matter of helping people understand and actually, I guess, trust the product, because again, the stigma, amazingly, even though, again, you say, that a lot of those rules were changed a long time ago, but the stigma still lingers.
And it's funny that you say that, because it's even young people, younger, that remember the stigma. So to address that too, Mutual of Omaha has been around for over 100 years. And they purchased my company, which used to be called Retirement Funding Solutions,
Okay.
specifically for the reverse mortgage ability. It's one of the largest lenders in the country, and they wouldn't go into a land where it was not beneficial for their customers.
Right.
Basically is what I'm saying. Yeah.
Yeah. Yeah. No.
And so to address the questions, and sometimes people don't want to ask me, or they don't want to come to me first unless they do some research. So on my website, they can actually do calculators. They can do a calculator for purchase. They can do a calculator to refinance, or a calculator for the sequence of returns. So all that, and even one for like, do I collect Social Security now or later kind of thing. And it has frequently asked questions, because all these questions you ask are being asked all the time.
Right.
And I actually had one gentleman, and it was a while ago, and he goes, "This sounds too good to be true. Is this a government handout?"
Right. Like, what's the catch? Right.
Exactly. And it's like, there is no catch. It's the best loan ever. And once people understand it like you do, they just love it. They think it's terrific.
And I think it's good. I mean, the key word, I think, in the acronym is conversion. I think if people understand, it's like, look, this is your money that you've already been paying into your home. You're just converting it from being equity in the property to kind of liquidating it so that you can make use of it now, as opposed to just sitting on all this equity and still, paying.
Going to the grocery store and saying, "I got $1 million home."
Right. Exactly. Right. Yeah. So, it's really putting that equity to work for you in the times when you can really use it, and that's why I say, I have the conversation with people. It's like, look, you earn that money, you put that money there, you should be able to benefit from that money. And so that's what this program allows you to do, is to tap into that and more easily than if you had to qualify based on employment or income, which may not be the same as it was before you retired, for example. So yeah.
Yeah. And most of, my people that I work with involve other people that are important in their lives. It could be a financial advisor, it could be their realtor, it could be their children. Yeah. And most of the children are, "Mom and Dad, get this loan. This is the best thing for you." Yeah. And the reason why they say that is, to your point, that they're sitting on equity, a lot of it. And we don't loan all the equity out.
Right.
We don't loan you can't, some people call me up because they're used to conventional loans, and what's the loan to value? And, we don't use loan to values. It's based on age, interest rate, and appraised value, and then the pot. And with a reverse mortgage, the older you are, the more money you qualify for.
Right. Yeah. Yeah. Wow. Well, is there anything I missed? Did I miss any questions?
I don't think so. I think that we had such a conversation, and now I think that you're able to talk about it.
Yeah. No, I really love this program, and any opportunity I get to share it with someone when I am in a conversation and I hear them say, "Hey, oh, my mom is really struggling, on a fixed income, and it's like, wow, this could be something that might be helpful. I just want to be able to have people be informed so they can make decisions that are going to best benefit them. And that's really why.
And that is exactly how I operate. We talk and we decide, they decide after getting the information, whether it's the right fit. Sometimes it might not be. Yeah. And when we talk about, sometimes it might not be, maybe they want to move in a year. Well, why do it before you move? Wait till you move and then do it. Right. Or maybe they want to go into assisted living, or have somebody do their laundry for them. That's great, but that's not the right product. Right. Or in the case that we mentioned, multiple heirs, somebody wants to stay in the house, then maybe it's not the right product.
Right. But that's the main thing is, when when working with people, especially in this process of when they're looking to either buy or sell a home, we really have to get down to what their core goal is. What is your key objective? And then what solutions do we have to help you meet that objective? And we just want to make sure they know all their options. You don't know what you don't know. And if this is a product that could work for you and no one's ever mentioned it to you, then how do you know this might be the perfect, product that's going to help you to achieve the goal that you're after? So do you have anything else before I
do
wrap us up?
not.
Okay.
Thank you so much, Sharon. It was great talking.
Well, thank you. I mean, again, I have this conversation with people often, and I just really wanted to demystify a lot of the misconceptions around the reverse mortgage, but I'll call it by its appropriate name, which is the home equity conversion mortgage. So if you have any additional questions, or you want to find out a bit more about if this is a program that could be helpful for you or a loved one, give Cheryl McCarthy a call. You'll see her contact information right below her little picture on the Zoom screen. And just reach out, and it's just to learn more about it and to see if it's something that could be a fit for you. If you have any other questions with regard to real estate, feel free to give me a call. Thank you all for hanging out with us. I hope you were able to get some value out of this conversation, and we'll look forward to seeing you all again soon.
Thank you, Sharon.